having me on. I look forward to spending some time with you guys on this Valentine's weekend and President's holiday weekend too. So congratulations to those of you that are taking the time out of your day to get some financial information. As Lori indicated, I am a certified financial planner. I've been in practice about 24 years, so I've pretty much seen it all throughout these years. So feel free to ask us some questions as we're going through the presentation. It'll probably make it a lot more interesting for everybody than listening to me speak for 45 minutes or so. But I wanted to let you know that I do have a fair amount of clients that are LGBT, whether they're single or married, whether they're married in a state that recognizes their marriage or not. They're domestic partners. So like I said, I've kind of seen it all, and we'll kind of keep this presentation high level because there are so many different states and the different configurations with our relationships. That being said, my partner and I are going on 30 years of being together. So we are married now in the state of California. We were registered domestic partners and now married, and April will be 30 years. So I understand what it takes to keep a marriage together, and when it comes to financial planning, how to plan with when we have families as well, because we both have, or we have 2 kids. They're 15 and 18 now. So I understand college planning and how to stretch a dollar to cover all of the things that we need to as parents, and getting along with financial planning. So that'll kind of be the basis. We'll go through a lot of information, high level, again, on estate planning, protection planning, and then retirement planning. So kind of go in that order. To start with, though, we'll talk about plan with pride when it comes to particularly the LGBT community, and then what happens, again, if we're in a state that doesn't recognize your marriage. We want to talk about kind of, all of us are probably pretty aware of what happened on June 26th and the ruling with regards to defense of marriage. So with that, we know that now we have a lot of the federal rights, not all of them, but a lot of the federal rights now. Here's a map that kind of shows, it needs to be updated. It actually shows kind of the landscape of those states where we do have marriage that's legal, where we still have a lot of work to do, and then those states that also do recognize domestic partners or some sort of civil union. So with regards to DOMA, we know that it had a huge impact with regards to federal benefits, but then also we're just finished up, or we're in the middle now, I guess, of tax season. You guys had a couple of weeks ago a CPA on talking about tax planning, and now if you are in a federally recognized marriage, you do need to file your taxes as married now. You can go back and amend your tax returns if that's going to be more favorable to you. And those of you that are in domestic partnerships, registered domestic partnerships, those you need to file your state tax return if you're in a community property state as joint or married. So here's some other things, key impacts with regards to DOMA decision and financial planning. Really huge was Social Security. So now our spouses are now eligible for our Social Security if we are were to pass away. Federal taxes, estate and gift taxes, employee health care benefits, retirement and pension, divorce, and immigration. Those are the key things that benefits a DOMA. Here's a little bit of a snapshot on if you're married in a state that allows same-sex, then you are eligible for state and federal benefits. If you get married in a state that allows same-sex marriage but you move to a state that doesn't, then you're not eligible for some of the state's benefits. So it depends on, again, this is a changing landscape and states are coming on board every day. So I would say that none of this is set in stone. So as you're starting to do some planning, really see with regards to what state you're in now, what state you got married in, or if you're registered, and then where you're going to move to. So we can go over this at more detail if we need to. Most important, though, what we talk about today is estate planning, protection planning, and retirement. So estate planning is really nothing more than passing on, your legacy, your assets, income to your loved ones. And we'll talk about the best way to do that. The next is protection planning. So whether that, you have some sort of short-term illness, long-term illness, unfortunately you pass away, all of those things kind of go under protection planning. And then retirement planning. Ultimately, spending the rest of your life with your loved one and not having to worry about finances. So when it comes to planning with pride and estate planning, really estate planning, again, is organizing all your personal affairs. So I know that many of you, the side of you, couple that's in the military, you probably have a will. Those I do find couples, so a lot of times one will have a will and the other one doesn't. So the one that's not in the military might not have an updated will. That's very important. I'll give you a little story here, because with the kind of will package, you also need power of attorney to be able to make financial decisions or medical decisions for the other partner. And then you also need the health care directives, which lets your family members, loved ones know what you would want to have happen in the case of an emergency. I'll give you two stories recently of clients that I've been dealing with. One is, we'll call him Jimmy to protect the innocent, but he was involved in a pretty serious accident, had some head injury, was here at the different trauma units here in San Diego, and unfortunately he did not have health care directives nor a power of attorney, and he owned a small business. He's single. He has a son that just turned 18, and the doctors and everybody were kind of looking at him, to make decisions, medical decisions. He had not the wherewithal or expertise or comfort in making any of those decisions, so that put him in a really bad position. Also, Jimmy owned a business, and they weren't able to carry on the business for quite some time. They weren't able to pay the employees, handle some of the banking accounts, pay the insurance bills, which are very important when you're going through a long-term hospital stay. So luckily he was able to come kind of coherent enough after a couple of weeks that we were able to at least get a notary to the hospital and be able to have one of his older brothers become power of attorney for him to be able to carry on his some of his business, pay his bills. But that was a very serious situation and could have been taken care of had he just done a little bit prior planning. Another one has to do with Steve. Real quick, I'll tell you about him. Is Steve had a long-term partner. They were domestic partners. They were not registered domestic partners. But his partner was very sick, so he was in the hospital, dying of cancer, and his partner's parents kept trying to come in and intervene and try and get the sick one to change the power of attorney over to them and away from his partner. So he even did the proper documentation, and they were still trying to get in the way of that. Luckily, Steve did have all the documentation. The nurses had it on file. The doctors had it. So he was able to continue to take care of his partner and be by his bedside until he passed. So those are some very important stories. Talks about why we need these kinds of documents. On your estate planning team is clearly your partner. You'll need a financial professional like a financial planner, your accountant, and an estate planning attorney to help you draft the proper documents. Again, what the basics of a estate plan has incorporated is a will. That's the documentation that tells the judge what assets go to the, what person, what you want to leave behind. We'll name a guardian if you have children. Again, the durable power of attorney for health care, I talked about that, visitation documentation. All of these kind of things are involved in an estate plan. When it comes to protection planning, this is important because in protection planning is that we're never what's going to happen to us, right? So we could have, you know, a very serious accident. We could have short-term illness, anything in between, and we need to make sure that our family's prepared so that should we survive our injury or accident, that we're not financially destitute when after we finally survived it. And then with regards to life insurance. So let me talk about life insurance real quick. As service members, you have the SGLI insurance. I'm not sure, you know, everybody has a different amount as to how much you took out. There's a maximum amount that you can get in the SGLI, so it's important to know what your coverage is and if you're covered enough. There is a great calculator, a life insurance calculator at benefits.va.gov. Again, benefits.va.gov. If you want to check that out, it's a really good calculator, kind of walks you through the steps of what are your financial obligations, what would be things that you would want paid off should something happen to you. If you were to pass away, do you want your mortgage paid off? Do you want to set some money aside for college funding? If you have kids, what kind of additional income, spousal income, would your spouse or partner need? So it's a really good calculator if you want to look at sometime. I can tell you that most of the time people do not have enough. So when, rarely when I run an analysis do I see that that our clients have enough life insurance. They're really mostly grossly underinsured, and it will make a huge impact on your family's life depending on what amount of insurance you have. It's more important to have the right amount than the right kind. I can tell you with my wife, she's not going to care what company it came from, what type of insurance it is, as long as there's some coverage and the enough coverage should something happen to me. Savings account also comes to, plays in protection planning as well. We need to have a good savings. So whether you're in your 20s and 30s or your 40s and 50s, you always need a rainy day account. And we in the business like to say at least have 3 to 6 months of your expenses set aside in a savings account. So that's for most people that usually tends to be around $10,000 to $15,000 or so should be set aside in just a regular type savings account. I'm not sure if you're aware of the DOD Savings Deposit Program, but that is a great program to be able to set money aside. You can put up to $10,000 in there, and it's a 10% interest rate right now. That is amazing. So look up that if you're not aware of that. When it comes to retirement planning, that's kind of, we've got, sorry, I skipped over long-term care insurance. So long-term care insurance is definitely something that you want to look at also for yourself, definitely other family members. As we're starting to age, we're able to keep people alive a lot longer than we used to. So things that used to kind of kill people now are keeping them alive, so we have longer life expectancy and more things creep up in our older age, and long-term care insurance helps pay for care should you need it, whether it be in your home or in some sort of other living facility that cares for custodial care, somebody to come in and bathe and dress and take care of you, all those activities of daily living. That is definitely something you should look into, because the cost of needing that care is ranges, between $5,000, $8,000, $10,000 a month, depending on the city that you're in. So that could be a significant blow to your retirement plan, your financial plan, should you or a spouse or another family member need that.
Marci, can I ask a question?
Sure, yeah.
Sorry, this is Lori. So with respect to long-term care insurance, can you maybe identify the population or at an age at which somebody should start looking at plans? For example, is this something that somebody can purchase earlier on, or in general, do you wait until you're about a certain age or health status to purchase this?
That's a great question. So what I see is people put it off too long, and then they're, a health issue comes up and then they're uninsurable. So certainly we'd like to see people get it by the age about 50 or so. If you start seriously looking at that around that age, health-wise you should be pretty good still, and financially the premiums are a lot less than waiting until 65 or say even 70. So that's a good age if you have any kind of family health history of things, of diabetes or cancer, heart disease, things like that. You might want to get it sooner because, again, after something major like that, is in your medical charts, then you're unable to even secure it, regardless of what the premium is. I also encourage you to start asking, your parents. Blame it on me. Start blame it and say your financial planner is asking these questions. You want to know if your parents also have these kind of protections. Do they have an estate plan taken care of? Do they have a will or a trust, or do they have long-term care insurance? Because I find a lot of parents that we're now in this sandwich generation where a lot of people are taking care of their parents as well as their children at the same time, and that puts a huge financial strain on the family as well as an emotional strain and physical strain if you're having to take care of somebody. So if your parents or other family members had the insurance, perhaps that could relieve some of that strain as well. Is that good, Lori?
Sorry, yeah, that's
good. Okay. With regards to long-term care insurance, it is important to look around, do the analysis to see if you have enough assets that you could self-insure, or definitely look around to different companies to see what options might be the best for you. Now, I'll spend the majority of the time now on retirement planning, because this is an area that lines up directly with what's with military saves, and the amount of money that needs to be set aside for retirement is very under calculated for most people. The best thing we can do is just start off and do an analysis to see what do you even have available to you. So through the military, you have a pension. That amount that would pay out depends on when you started the military and kind of years of service. It's not going to be 100% of your income, so you're going to need to set some other money aside. One great place through the military is with your thrift savings plan. So I just met with a 27-year-old Marine on Thursday, and he's been saving a fair amount. He's got actually a really, really nice amount saved in a savings account. So it's great that he's been saving, he's been putting money aside, but he didn't do anything into the thrift savings plan, the TSP, because he wasn't sure how to invest. So he got stuck there. So he just kept putting money in the savings account, which is only earning him, not even 1%. Whereas if he would have been putting that same amount in the TSP, he could have spread it out to different funds within inside the TSP. If you're not familiar, you've got kind of a alphabet soup of different options between a G account, a growth account, an I account, an international account, or you can do what's called the life cycle funds, which is the L funds, and those life cycle funds are kind of prepackaged accounts for you. Different mutual funds already allocated to large U.S. companies, international companies, so on and so forth. In addition, they're kind of target dated to when you would retire. So they'll get more conservative and automatically adjust as you get closer to retirement. So had he put the money in the TSP last year, even if he was in that, an L fund, he probably would have earned, 15 to 20% on that account last year versus the 1% that he had in the bank. Not to say he didn't need money in the bank, but he had too much in there, and he really needs to have some, based on his age, a fair amount set aside for retirement already. So with the TSP, you can put away $17,500 a year. That doesn't mean you have to, but that's the maximum right now that you can put away, $17,500. If you are so lucky and you're over the age of 50, then you get to put away an additional $5,500 for a total of $23,000. So they allow what's called a catch-up provision, so you can catch up an additional amount if you're over 50. So that's the same figure if you also, if you have a spouse or partner that has a 401k. So maybe they work for a corporation and have a 401k, or even a 403b if they work for a nonprofit, a school, or a hospital, something like that, and they might utilize a 403b instead of a 401k. But again, all of those, whether it's a 401k, 403b, TSP, all of those are where you're setting money aside, deducting it from your income now, so you're not paying tax on it now, and it's growing tax deferred, and then when you go to retire, it's going to be taxable at that point in time. The other option I'll talk about is a Roth IRA. So that's also another account that you can set up. A Roth IRA compared to a traditional IRA is that a Roth IRA, you're going to open that up, you're going to contribute the money to that with after-tax dollars. So you're not going to deduct it when you complete your tax return. You're not going to deduct, let's say, the $5,000. You can do $5,500 into a Roth IRA. So let's say you put $5,500 in to a Roth IRA. You're not going to deduct that from your taxes on your tax return. So it's going to grow tax-free from that point of you establishing the account. So that's a really nice account to be able to grow tax-free, especially if you think you might be in a higher tax bracket when you retire. All of that money is going to come out tax-free. Your spouse can contribute to that, so even if you have a non-working spouse, or as mine says, she works full-time, but just not outside the home, right? So if they're a stay-at-home parent, they can also contribute to a spousal IRA. Even if they don't have earned income on their own, they can do a spousal IRA. It would be good at some point if you did a calculation as well on the retirement plan to see how much you've got set aside. Are you setting aside enough so that you know when you do start contributing to these different various retirement strategies, you'll know how much you should be putting aside. A good rule of thumb would be trying to at least do 10% of your income. That would be a great stab. If you save automatically, it's a lot easier to get it done. You'll learn to live with what's left over in your paycheck and just have it come out of your pay automatically and go into the TSP or the Roth IRA or whichever account you have available to you through your employer. Annuities are also another good retirement vehicle. They will allow you to grow your accounts tax-free or tax-deferred, I should say. So you put money in there and then they grow tax-deferred. I wanted to jump to college funding real quick in case some of you are on the line that are parents or thinking about parenting or maybe even have grandkids. That there are some great new accounts called 529 accounts. These are college funding accounts. You can look at online and look at different plans, but they are also a way to be able to set money aside tax-free, grows tax-free as long as you use them for qualified education, college expenses. To review, I think if whether you're in your 20s or 30s or 40s and 50s, putting together kind of the acronym of the SMART goals, if you're familiar with that, is really defining what your financial goals are. So whenever we ask a client, when they say they have some financial goals, we want to know specifically what it is, what's the time frame, what are you trying to save up for? So you're trying to save up for, new car, is it a house, is it college, is it retirement, is it vacations? And then what's the time frame? So is it like this young Marine that I met with he wants to buy a house in a couple of years. So we helped him, define really what does that mean. So a couple of years, is that 3 years or is that 5 years? Do you want to buy a house for, $250,000 house, or you here in, San Diego on the West Coast and you need, 500 to 700,000? What is it? What is that goal? So then you can line up the proper savings strategy for it. The goal needs to be measurable, attainable, reasonable, and timely. So this is what I try and teach my kids as well, is to create SMART goals. So again, SMART stands for specific, the M is measurable, the A is attainable, R is reasonable, and T is timely. So if you kind of do that with your spouse or partner, and as well as kids, try and come up with your different financial goals, being specific, measurable, what is it that we're trying to accomplish, get everybody on the same page, make sure it's a reasonable goal, and then what's the time frame. If you're able to do that kind of with each goal, whether it be a financial goal or personal goal, then everybody's able to kind of rally around and support that. The militarysaves.org definitely had a great, has some great worksheets on there. If you want to look that up to help you with regards to saving and getting a savings plan together. Once you've got that emergency account of, let's say that 3 to 6 months, that 15,000 or so set aside, 10 to 15,000, something like that, then you can start thinking about these other saving strategies or retirement strategies. But find if you don't have those taken care of first, then you get into credit card trouble because you're not managing your expenses, you're spending more than you make, and then you start using the credit cards. So if you're a little bit on the younger side, just starting out, I would say manage your expenses so that you don't get into any credit card problems. If you do have credit cards, because they're important to establish your credit, so if you have them, just pay them off at the end of every month. That's going to be key so that you can maintain a good credit score, because a good credit score is going to give you lower interest rates when you do go to borrow. We talk about good debt and bad debt in our business all the time. Good debt are things maybe like for a home, an asset that's going to appreciate, where it's going to give you your shelter. A mortgage will be considered good debt. You're going to need that. You might not be able to pay cash for a house. So if you have a mortgage, the lower the interest rate is going to be better, but your interest rate is going to be based on what your credit score is. So if you're not checking your credit score on a regular basis, that would be important to do. There's a lot of great apps now for your phone where you're able to really track. Credit Karma is one of them. Credit with a K, Karma, is a really nice one that helps track what your credit score is, and it gives you hints as to how you can increase your score. That'd be a good one, because then it'll also notify you if something's going south as well. Let's see. After you have that emergency account, then definitely the retirement savings is something you definitely want to start automatically saving to. Here's a point I wanted to talk about for those of you that are getting closer to retirement, and looking at the difference between the survivor benefit plan and life insurance. If you're contemplating the VGLI, the Veterans Group Life Insurance, what you want to do is, prior to retiring, is look at different insurance alternatives, different life insurance companies besides the VGLI, and just compare the premium and make sure that you apply for that a fair amount of time in advance of you actually separation from service, because what I find is that a lot of times, when you're doing your exit interview, you're telling them everything that's wrong with you so that you can get a higher retirement benefit, but then you shoot yourself in the foot when it comes to anything having to do with medically underwritten policy like life insurance or long-term care or something, because now your medical record is filled with additional information because you're trying to, on one hand, get as much a maximum benefit as you can. On the other hand, we want to try and get life insurance at a least expensive premium. We want your medical record to be clean. So you want to look at that before. If you do have compromised, health and some serious health considerations going on, just be aware that you can convert the SGLI to the VGLI, to the Veterans Group Life Insurance, and as long as you apply within 240 days of your discharge, there is no evidence of good health required. So it's important that you understand the timing of that for those of you that are getting closer to retirement. But again, it's important for everybody to understand what their pension benefits are, what the amount would be for retirement, so that you know how to complement that and supplement with additional savings. I'm not sure, Lori, if there's any questions that have come in.
Sorry, yeah.
Going through a lot of different topics here.
No, this is great. All of the topics that you've covered are fantastic. One question came in, and it says, and it's referring to, like earlier on in the conversation, we are just kind of going through an overview of things that have changed with respect to DOMA. So one specific question came up saying that with respect to Social Security, this individual's in Virginia. In Virginia, Virginia is saying that they don't have to update their marriage status since they didn't change their last names. Do you know if that's correct? I know that's I
don't know if that's correct, but that's a great point, is that I do recommend that everybody go through, if they have gotten married, is they look at the beneficiary designations of everything that they have and retitle that to spouse. Because although they're married, it will make things a whole lot smoother and easier if they were to pass. So let's say they have an IRA or a 401k. Excuse me, there's a big difference between inheriting something as a spouse and not having to pay tax on it right away as inheriting it as a friend or roommate.
Absolutely. Yeah, no, that's a great point.
So it's a lot easier to have, if all of those documents are updated to say spouse.
Yeah. I'm hesitant to answer this question one way or another because I too don't actually know the correct answer, but my gut feeling is that it makes me a little nervous that the status isn't updated to married regardless of what the information is coming from, just because you didn't change your last name. It makes me a little bit hesitant to say, yeah, you're free and in the clear. My gut reaction for default for telling people is I would change everything that you potentially can, unless doing so is unnecessary and would result in some sort of detrimental outcome. But in general, because of the information, because of the reasons that you stated, is that there's unfortunately, it tends to be lots of the unexpected or unintended things that occur just in normal everyday life. And when one of those things aren't updated, it can really cause a huge, huge problem in terms of barriers and challenges for the spouse, either the service member or the non-service member, civilian spouse. So.
Right.
I had a couple of questions about, let's see. So you had mentioned the DoD Savings Deposit Program where people could deposit up to $10,000, and right now, I believe, like you had mentioned, that it's at 10% interest rate.
Correct.
Can you expand on that? I'm not sure how much more you know about that, or if there is actually like a website or somewhere someone can go, because I'm not sure if I'm thinking of it as the same thing that you're mentioning. I definitely know that when a service member is deployed, they have access to a certain a specific savings program that's only offered to deployed individuals, and it's something that is definitely a high interest yield. But I'm not sure if that's the same thing that you mentioned or if this is something different.
Yeah, the one I'm aware of is if you are receiving, I forgot to put this caveat, if you're receiving a hostile fire pay.
Okay.
So if you're receiving that and you're deployed, that's the special program that you're able to take advantage of.
Yeah, definitely. So for any of our people who are on the line who are maybe spouses of deployed individuals or are friends of individuals who are deployed. It would be good information if that service member doesn't know about that.
Sure.
Usually it's kind of mentioned in their workup in the deployment, but there's so many other things that the service members are kind of focusing on during that time that sometimes this falls by the wayside, specifically more for our younger service members who might not be focusing on, retirement just yet. But it's something to kind of spread the word about, as it's, for anybody who has a savings account now, look at your savings interest, and I can guarantee you it is far less than 1%. So a 10% savings or yield is just something that's absolutely unheard of.
Exactly.
Okay. And then, so can you kind of go over, what about people who might not have a job? I just really want to kind of stress this to some of our spouses are struggling with employment. And that's kind of unfortunately endemic to our military spouse community, in that we have a difficult time sometimes maintaining employment, let alone full-time employment that does offer our own kind of retirement or savings programs. Can you just kind of refresh some of the things that we as spouses could be looking into to capitalize what we can contribute?
Yep.
Yeah.
So the things that you could, clearly a savings account, just a good solid savings account everybody needs. So once you have that set aside, 3 to 6 months of your expenses set aside, in order to know what your expenses are, you're going to have to try and do a little bit of calculation. I can email anybody if they want a nice kind of tracker that we use with regards to expenses to kind of break out what are your household expenses and how much you spend on gas and food and groceries and entertainment and that sort of thing, to get a good handle on what your monthly expenses are. Then you know how much to set aside. Once you have your savings account, your first line of defense taken care of, then we can go into the other retirement accounts. So for unemployed spouse, they can contribute to a spousal IRA or a spousal Roth IRA. In addition to that, if there are funds, and the family does have enough funds to be able to set aside, in addition to the Roth IRA, which again the maximum is $5,500 right now. If they want to do more than that, you have the ability to save more than that, then you can always just do open up an investment account with mutual funds. And mutual funds are nothing more than like a basket full of stocks. Everybody's familiar with kind of stocks and bonds. Well, a mutual fund is a basket full of those. So instead of just owning one company like Microsoft or Pepsi or Qualcomm, you're going to own, in a mutual fund, you might own 200 or 300 companies. So your risk is spread amongst a lot of different companies, and they can set that up at any time, and it doesn't matter if they're employed or not.
Okay, great. Another question is there a benefit to having, for the spouse to have their own, aside from a legal benefit, if there is any sort of divorce or anything like that, assuming that our couples are all going to stay together, is there any added benefit of having, a spouse have an additional retirement account, in addition to say the service member has their, they have their pension, they have their TSP, and they're contributing to a Roth IRA. Is there any additional, benefit on having another, separate, say, 401k or whatnot from, say, Fidelity or any of the other, different companies out there, or would it be best to just kind of pool that money into the service member's account?
I think a spouse always feels good to have some money that shows up in their own name too. So it wouldn't hurt to, definitely have their own funds, just to become more financially stable as well, more financially aware, and feel like they're contributing to the family, future security. But as far as here's a misconception is that that anybody can open up like a 401k. So you can't do that. You have to be with a company that sponsors it. So if you want to open up an account with Fidelity or Vanguard, that's fine. It just might not be in a 401k. It just might not be tax advantaged, if you will.
Right.
So that's why if you want it to either benefit you from taxes now or later, the now would be is that you do a traditional IRA and you deduct that amount from your income now that you're going to put away, or you do the Roth IRA and it's going to grow tax-free. So once you have kind of maxed out that, then you could certainly go ahead and open up an account direct with Fidelity or Vanguard or American Funds, whoever it happens to be. But you might as well take advantage and fill up all the buckets first that have a tax advantage to it.
Great. Another comment that's come up is, like I mentioned, many of our spouses do move a lot, and some of them are able to have gainful employment in every place that they've gone. They've been lucky. And maybe these individuals have several existing, either 401ks or 403bs, and they have multiple accounts. So I can even say personally that I have several accounts and don't know what the heck to do with them. So
Yep.
Can you speak
Military
to that?
accounts, I definitely see that where there's odd accounts just hanging out all over the place. So you can definitely roll all of those various accounts into one. You'd roll it into what's called an IRA rollover, and so that account can hold 403bs, 401ks, all of those different kinds of retirement accounts. You can all hold those. And then at that point in time, you can decide whether you want to convert that IRA to a Roth or not. The advantage to do it, so let's say you don't have that much income for this year, and this is kind of a lower income year for you and your family. If you were to convert that IRA into a Roth, you pay tax on the amount that's in that account, and then it grows tax-free forever from then on. So if you're in a low tax bracket year, that would be an excellent thing to do. You don't have to convert the entire amount. So if it's a large sum and you don't want to convert, a whole $100,000, you can convert 10,000 of it this year and 10,000 of it next year and start whittling away at it. But the more you get it into the Roth account, then it will grow tax-free.
Okay.
So at a minimum, you can start consolidating them and just get them into one account so you're not paying maybe service fees at multiple places. You're able to see how it's invested. Diversification, doesn't mean owning Pepsi in 5 different accounts.
Yeah.
It means owning, Pepsi and all different kinds of companies and having diversification.
And this rollover account, obviously it can be done if your multiple accounts are serviced by different types of companies. Is that right? Like if somebody has like a Vanguard and a Fidelity and whatnot.
Yep. So depending on the kind of where those funds are, they could maybe own the exact same funds. Sometimes if they're proprietary funds from a certain company, they might have to be sold and then transferred. So I could always chat with the person and see, what the kind of account it is. If they just fax me the statements or something, I could see, or email me statements. I could give them some guidance.
Okay. Okay, great.
Good question.
Let's see. There's no other submitted questions, so I'm just kind of fumbling through my notes really quick to see about other things that maybe people have commented to me or emailed me separately asking about. Let's see. What about...
While you're looking at that, I can tell you that the biggest thing that I see with my clients is if we can get people to, stay out of debt in the first place, or if they get into debt, get out as quick as possible. That's where they're spending a tremendous amount of energy, anxiety, with debt hanging over their head, and just a lot of interest. So they're paying a lot of, outgoing interest of, 10, 12, 15% on something, when they're only earning 1 or not even 1% in the bank. So if we can work on paying cash for everything, using a debit card for everything. If you don't have the money, wait, save up for it, and then pay cash for it. That'll serve you very well in the future. That's
actually a good point. So a lot of our families might struggle financially and so really actually do heavily rely on their credit cards, which might be out of necessity. However, that being said, if they're at a point where they're ready to kind of tackle their credit card debt, what would be like kind of the first steps, like just kind of, high level, what are some kind of steps that they could go if they're ready to say, you know what, okay, let's try to get this down?
Yeah. So definitely they got to list out all their credit cards, because that's the one thing is people don't like listing it and looking at it, and they actually got to see the reality of how much debt there really is and how much you're actually spending every month. So once you kind of like AA, once you recognize you have a problem, now we've got to attack it, and you can attack it one or two ways. One is going after the highest interest credit cards and paying those down first. Or depending on what your balance is and what your minimum payment, it may be more beneficial to pay off several quicker. And then once you have that amount, let's say you have 3 different cards and you're able to pay down 2 of them. Now you use the payments that you were paying on those 2 to attack that third one more aggressively. So you pay minimal on one and then a larger amount on either the higher interest rate one or the one that has a lower balance, so you can just get that one done. Now, let me caution you is that a lot of people are, get excited when they pay off their credit cards and they want to close their accounts. I would caution you, don't close your account, because that will negatively impact your credit score. So what you want to do is keep the account open. Don't use it, or don't use it, just use it sparingly, so that you maintain some activity, but pay it back off. Some people are just really scared that they're going to get back in the credit card trap again. But when you close your account, what you've done is you've lowered the amount of available balance, and your credit score is largely based on how long have you had credit, and then what is the available balance. So the credit limit, so if you've got large, if you're near the ceiling of what your credit limit is, and as you start bringing that down, your credit score is going to go up. But if you close out a credit card, now all of a sudden you're back up to the limit or higher to that ceiling of available credit. And you also might have closed out an account that had a really long history, one that you've had for 10, 15, 20 years, and that really impacts you as well.
Yeah, that's a really good point. The debt to available credit ratio is a huge part in people's credit score, and I think that that's something that many people forget, because you kind of just you're so focused on wiping out the debt that you just want to close.
Yep.
And then have you had any success with any of your clients who are actually calling their credit card companies and asking for lower rates?
That definitely has happened. Definitely, and telling them, that they're just going to move to another, company if they don't close it. So that definitely never hurts to call around. The other thing I want to caution people is that if you have credit inquiries, that will also lower your credit score. So you want to be aware, if you're going to make a big purchase, like a home or a car, pull your credit record yourself ahead of time, so you know if there's anything negative on there, and then you could start working to get that off. But then the other thing is if you're going to apply for, an apartment or something, and everybody wants to run their credit report, just print off a copy and take that credit report with you, and don't let them all run a report, because that will also have a negative impact when there's a lot of credit inquiries. Sometimes if it's all done within 30 days, it won't negatively affect you, but then other times we have seen it negatively affect you, and definitely if it goes past the 30 days, every time one of those credit inquiries and a report is run, it will negatively impact your credit score.
Okay. Excellent. And before we close out, I just kind of wanted to remind everybody that if you have a military ID, then you have access to base legal So there are legal offices on base that will assist with the will at least at a minimum for the service member, and then they're able to provide some sort of legal documents or assistance with creating legal documents for your military family, and that includes power of attorney documents and so on and so forth. So definitely try to locate the information or have your service member locate the information for the phone number for the base legal office, and then you can schedule an appointment and figure out what services they are able to provide you as a spouse in terms of a living will or other legal documents that might be helpful in terms of what would be important for Smart to keep for financial planning. That being said, I think that's done, at least on my end. Marci, thank you so very much.
Thank you, Marty.
If you have anything else to add, is there?
Nope, I'm just here for if anybody has any questions and needs anything, just reach out to me.
Excellent.
If I don't know it, I'll find the answer for you.
Excellent. Thank you so much. So Marci is physically located in San Diego, California, but she has made herself available. So if there's anybody that has lingering questions, feel free to contact either of us, and I'll make sure to shuttle all of the information to her so that she can connect with you all. Thank you again so very much, Marci, for the for voluntarily providing this information and taking the time out of your weekend to support our LGBT military families. And thanks to everybody else who has joined us on the call, and we'll see you or hear from you at our next webinar. Have a good weekend.